There is a ghost in the machine of Wall Street. It's a silent, invisible force that guides the hands of the most powerful money managers in the world, a force that dictates the flow of trillions of dollars, and a force that more often than not leads the entire financial world to the edge of a cliff and then pushes it over. Most people, the retail investor, the person saving for retirement, the entrepreneur trying to understand the market, they never see this ghost. They only feel its effects: the gut-wrenching lurch of a market crash, the bewildering evaporation of their 401k, the sudden chill of a recession. They blame the economy, they blame the president, they blame a faceless, nebulous thing they call the market, but they are wrong. The market is not a thing, it is a collection of people, and the ghost is a flaw in the way these people think. Warren Buffett gave this ghost a name. He called it the institutional imperative. It is the principle that organizations, from the mightiest investment bank to the smallest university endowment, will mindlessly imitate the behavior of their peers, regardless of whether that behavior is logical or suicidal. It is the tendency for the so-called smart money to act like a herd of lemmings, driven not by intelligent analysis, but by a primal, deep-seated fear of being left behind. Understanding this single powerful concept is like being given a secret key. It unlocks the ability to see not just what the market is doing, but twine Mars it is doing it. And in that why lies the greatest financial opportunity of your lifetime. Because when you can see the herd forming, when you can recognize the mindless momentum building in a hot sector or a trendy new stock, you gain a superpower. You gain the ability to step aside. You develop a contrarian investing mindset that immunizes you from the mass hysteria. And more than that, you learn to profit from it. You learn to search in the quiet, forgotten corners of the market, the places the herd has abandoned, and find treasures. You learn to sell your holdings to the stampeding crowd at the peak of their frenzy. This is not about a complex trading strategy or a secret algorithm. This is about market psychology. It's about rewiring your brain to think independently, to question consensus, and to have the courage to be lonely in your convictions. It is the fundamental principle that separates the amateur from the master, the victim from the victor. And it all begins with a story from a time when the world was convinced that one of America's greatest institutions was nothing more than a worthless relic. It was 1973. The air in America was thick with disillusionment. The ghosts of Vietnam still lingered. The Watergate scandal was eroding the nation's trust in its highest office, and the economy was sputtering under the weight of an oil crisis and rampant inflation. On Wall Street, the mood was even darker. The market was in the midst of a brutal bear market, a slow, grinding crash that would ultimately cleave stock prices in half. In this environment of fear and pessimism, certain industries were considered untouchable, radioactive. And none was more radioactive than the newspaper business. To the institutional money managers of the day, the grand titans of wealth management, newspapers were a joke. They were seen as dinosaurs, lumbering beasts of the old world, whose businesses were being eaten alive by the new dominant force in media, television. Network television, with its coast-to-coast reach and colorful broadcasts, was the future. Newspapers, with their messy ink and day-old stories, were the past. This wasn't just an opinion, it was an undisputed truth. A consensus so solid you could build a skyscraper on it. Every major fund had dumped its newspaper stocks. The financial analysis from the big brokerage houses was unanimous. Sell. The narrative was simple and deadly. Advertising dollars were flowing away from print and into television, and the trend was irreversible. And so, stock prices for even the most prestigious newspaper companies on earth were in freefall. Among the hardest hit was one of the most respected names in American journalism, the Washington Post Company. The Post was more than just a newspaper. It was a national institution. Its reporters, Bob Woodward and Carl Bernstein, were at that very moment peeling back the layers of the Watergate scandal, a feat of journalism that would ultimately topple a president and win the paper a Pulitzer Prize. The company was run by Katharine Graham, a woman who had taken over after her husband's tragic death and had steered the paper with fierce intelligence and courage, most notably by defying the Nixon administration to publish the Pentagon Papers. And yet, on the New York Stock Exchange, the Washington Post Company was treated like toxic waste. The institutional imperative was in full effect. No fund manager wanted to explain to their investment committee why they were holding stock in a dying industry. It was easier, safer for their career, to just follow the herd and sell. The result was a market valuation that was not just cheap, it was ludicrous. The entire company, the newspaper, Newsweek magazine, several profitable television stations, and other assets, was being valued by the market at a mere $80 million. To an outsider, to the 99% of investors who followed the headlines, this seemed logical. Newspapers are dead, so the stock is cheap. Simple. But in Omaha, Nebraska, a man named Warren Buffett was looking at the exact same situation and seeing something entirely different. He wasn't looking at the stock price. He wasn't listening to the chorus of pessimistic analysts. He was doing something the rest of Wall Street had forgotten how to do. He was thinking like a businessman. Buffett's approach, his secret weapon in the world of stock picking, was to ignore the ticker entirely. He asked himself a simple question. If I had the money, what would I pay to buy the entire Washington Post company, to own it as a private business? So, he got to work on his own stock analysis, not from a place of fear, but from a place of cold, hard business logic. He looked at the company's financial statements. He saw that the television stations alone were immensely profitable and growing. He estimated their value, conservatively, at over $100 million. He looked at Newsweek and the other assets and pegged their value at another substantial sum. And then he looked at the newspaper itself. Was it really a dying relic? Buffett saw a different story. He saw a dominant newspaper in a major metropolitan area. In the 1970s, before the internet, if you were a big department store or a grocery chain in Washington, D.C., you had no choice. You had to advertise in the Post. It had what Buffett would later call a, quote, franchise, an economic moat. It was a local advertising monopoly. He calculated the earnings power of the newspaper, what he called owner earnings, the real cash the business generated for its owners each year. He saw a business that was gushing cash, a business that was not dying, but was in fact deeply and durably profitable. When he added it all up, the TV stations, the magazine, the newspaper, Buffett calculated that the intrinsic value of the Washington Post Company was, at a bare minimum, $400 million, possibly as high as $500 million. And yet, the market, in its infinite wisdom, in its herd-like panic, was offering to sell him pieces of this $400 million business for a total price of just $80 million. It was like finding a Rembrandt at a garage sale with a $10 price tag on it. While the institutions were fleeing, driven by a narrative of doom and the imperative to copy each other's portfolios, Buffett quietly began to buy. Between 1973 and 1974, he invested over $10 million, acquiring more than 10% of the company. It was a massive bet, a significant portion of his partnership's capital placed directly against the unanimous consensus of the financial world. He was alone. But he was not guessing. He was certain. He knew that the market's price was a reflection of temporary hysterical emotion. His calculation of value was a reflection of permanent, underlying business reality. And in the long run, reality always wins. The years that followed proved him spectacularly right. The Washington Post Company didn't die. It thrived. The profits continued to roll in, and Katharine Graham proved to be an exceptional manager of capital. The market eventually woke up from its stupor. The fear subsided, and investors began to see the company for what it was, a phenomenal business. The stock price began to climb, then soar. Buffett's $10 million investment blossomed into one of the cornerstones of his fortune, eventually becoming worth well over $1 billion. It was a monumental victory for contrarian investing, a testament to the power of independent thought. And it was all made possible by understanding and exploiting the institutional imperative. He saw the herd running from a perfectly healthy lion because they had mistaken its roar for a death rattle, and while they ran, he walked in and claimed the kingdom. This anecdote is more than just a great story about a brilliant investment. It's a foundational lesson in the psychology of markets. What drove every single one of those professional, highly paid, supposedly brilliant fund managers to sell their shares in a wonderful business at a fraction of its worth? The answer lies in two powerful cognitive biases: social proof and the authority bias. Social proof is the deeply ingrained human tendency to assume that the actions of others reflect the correct behavior in a given situation. It's a mental shortcut. If you're in a foreign city and see a crowd running in one direction, you don't stop to analyze the situation. You start running too. You assume they know something you don't, like there's a danger they're fleeing from. In the financial markets, this shortcut is lethal. A fund manager in 1973 saw that Goldman Sachs was selling newspaper stocks. He saw that Morgan Stanley was selling newspaper stocks. He saw that the Wall Street Journal was publishing articles about the death of print. His brain, using the social proof shortcut, concluded, "All these smart people can't be wrong. I must sell too." He didn't do the work Buffett did. He outsourced his thinking to the crowd. He felt safer being wrong with the group than being right all by himself. Compounding this was the authority bias, our tendency to give more weight to the opinions of authority figures. The authority figures in this case were the star analysts at major investment banks, the editors of financial publications, and the senior partners at competing funds. Their consensus acted as a powerful gravitational force, pulling everyone's opinion into alignment. To question their verdict was to question the entire financial establishment. It was an act of rebellion that few had the stomach for. This is the cerebral level at which the institutional imperative operates. It's not a conscious decision to be foolish. It's a subconscious surrender to social pressure and perceived authority. For an institutional manager, the personal career risk of being a contrarian is immense. If you buy the Washington Post in 1973 and the stock goes down further, you look like an idiot. Your boss asks, "Why did you buy this piece of junk when everyone knew the industry was dying?" You could get fired. But if you sell the Washington Post, along with everyone else, and it goes down, you're safe. You can tell your boss, "Well, everyone got it wrong, the whole market went down." You were conventionally wrong, which in the world of professional wealth management is often preferable to being unconventionally right, because the path to being unconventionally right is often paved with a period of being unconventionally wrong. Buffett, by operating outside this institutional structure, was free from these pressures. His only boss was his own reason, and his only benchmark was business reality. So how can we, as individual investors, as entrepreneurs, as people trying to achieve financial freedom, apply this lesson? How do we build a mental model to protect ourselves from the siren song of the herd? The blueprint can be called the "what if you owned the whole thing" model. It's a disciplined, step-by-step process for stock analysis that forces you to think like a business owner, not a stock gambler. Step 1 is to completely and utterly ignore the stock price and the daily news chatter. Imagine the stock ticker doesn't exist. Your task is not to guess which way a line on a chart will wiggle. Your task is to value an entire operating business. Step 2 is to acquire the company's annual reports, the 10K filings for the last 10 years. Read them. Not just the glossy letter from the CEO, but the messy financial statements in the back. Your goal is to understand the fundamental economics of the business. How does it make money? What are its profit margins? How much debt does it have? Is it consistently profitable? Step 3 is to calculate what Buffett calls owner earnings. This is the key. It's not the reported net income, which can be manipulated with accounting tricks. It's the real cash flow of the business. You calculate it by taking net income, adding back non-cash charges like depreciation and amortization, and then subtracting the average amount of capital expenditures the business needs to maintain its competitive position. This number tells you the truth. It's the amount of cash you could theoretically put in your pocket each year if you owned the entire company. Step 4 is to assess the company's competitive position, its moat. Is it a dominant force like the Washington Post was in its local market? Does it have a strong brand, a patent, or a low-cost production advantage that protects it from competitors? Be brutally honest. A weak business, no matter how cheap, is not a bargain. Step 5. And only now do you think about price. Based on your calculation of owner earnings and the durability of the company's moat, what would you, as a rational private buyer, be willing to pay for this entire business? Come up with a number. Let's say you determine a business is worth $1 billion. Step 6 is the final step. Now you look at the stock market. You multiply the current share price by the number of shares outstanding to get the market capitalization. This is what the market thinks the whole business is worth. If the market capitalization is $2 billion, you walk away. The price is too high. But if, as in the case of the Washington Post, the market capitalization is a mere $80 million for a business you know is worth at least $400 million, you have found a true opportunity. By following this model, you anchor your decision-making in business reality, not market sentiment. You become immune to the institutional imperative because your analysis is independent of it. To truly appreciate the power of this model, we must spend time examining its opposite, the path of the 99%. This is the path most investors, both retail and professional, tread. It is a path paved with headlines, hype, and ultimately, financial disaster. The 99% don't read 10K reports. They read news articles on their phone. They don't calculate owner earnings. They look at the stock price chart to see if it's going up. Their process begins where Buffett's ends. They see a stock like the Washington Post plummeting, and their first thought is not, "I wonder what the underlying business is worth," but rather, "Something must be terribly wrong, I need to get out." Their decision is driven by the price action itself, creating a vicious, self-reinforcing cycle. The price drops, which triggers fear, which causes more selling, which causes the price to drop further. The narrative of "newspapers are dead" provides the intellectual justification for the emotional panic. They don't engage in stock picking. They engage in story following. They sell the story of the dying newspaper in 1973. 30 years later, they would buy the story of the new paradigm.com company with no earnings because that was the popular narrative then. The 99% path is about outsourcing your thinking. You trust the analyst on TV, the headline on a website, or the sentiment on a stock market forum. The catastrophic consequence is that you are guaranteed to buy high in moments of peak euphoria and sell low in moments of peak despair. You become the market's liquidity, the person who eagerly takes overpriced shares off the hands of smart investors like Buffett at the top, and who fearfully sells their own high-quality assets to them for pennies on the dollar at the bottom. It is a surefire path to the destruction of capital and the failure to achieve any meaningful portfolio growth. The direct financial connection here is stark and quantifiable. When Buffett invested $10 million into a company the market valued at $80 million, he was buying a dollar's worth of prime assets for 20 cents. Think about that on a balance sheet. The book value of the company's assets, its tangible worth, was many times higher than the price the market was putting on its stock. But Buffett's analysis went deeper. He wasn't just buying assets. He was buying a claim on future earnings. Let's use conservative numbers. If the business was earning, say, $40 million a year in true owner earnings, and Buffett bought the company at an $80 million valuation, he was effectively buying the business at a price-to-earnings ratio of 2. That's an earnings yield of 50%. It's like buying a bond that pays you a 50% interest rate every single year. The institutional herd, by selling at that price, was willingly giving away this incredible stream of cash flow for a pittance. The financial advantage Buffett gained was monumental. Every dollar he invested was supercharged. It wasn't just about the eventual capital gains when the stock price recovered. It was about the immense margin of safety. Even if his valuation of $400 million was wrong, Even if it was only worth $200 million, he was still buying at a massive discount. The institutional imperative creates these absurd pricing anomalies. It disconnects a company's stock price from its underlying business value. For the investor who has done the homework, who has built their own conviction based on facts and logic, this disconnect is not a risk. It is the single greatest opportunity the financial world will ever offer. It is the opportunity to buy wonderful businesses from a panicking crowd at prices that make long-term financial freedom an inevitability. The fear that gripped the sellers of the Washington Post in 1973 was not an isolated incident. It was a symptom of a deeper psychological phenomenon that drives institutional behavior. To truly master the contrarian mindset, we must dissect this phenomenon, pull it apart, and understand the gears and levers that make it work. The institutional imperative is not just about one-time panics. It's about the slow, creeping, and often pleasant-feeling march toward collective delusion. And there is no better example of this than the story of the Nifty 50. In the late 1960s and early 1970s, a new investment philosophy took hold of Wall Street. It was a seductive and simple idea. The theory was that there existed a group of about 50 large blue-chip companies like Xerox, IBM, Polaroid, and Coca-Cola, that were so good, so dominant, that you could buy their stock at any price and never have to sell. They were called one-decision stocks. The only decision you had to make was to buy. Their growth was believed to be so certain and so rapid that no price was too high. You could pay 50, 60, even 100 times earnings, and you would be fine because the inevitable growth would soon justify the lofty price. This was the pinnacle of institutional groupthink. Every major bank, every trust company, every mutual fund piled into the Nifty 50. It became the centerpiece of their wealth management strategy. If you were a portfolio manager, you had to own these stocks. Not owning them was a greater career risk than owning them at absurd valuations. Imagine the conversation with your clients. Why don't we own Polaroid? It's the hottest stock on the market, every other fund owns it. It was far easier to just buy Polaroid and ride the wave. The social proof was overwhelming. All the smartest people in the room agreed. These were the companies of the future, and price was no object. The performance of these stocks was incredible, which created a powerful feedback loop. As more institutions bought them, their prices went up, which proved the theory was right, which in turn attracted even more buyers. The narrative was intoxicating. These weren't just stocks, they were tickets to a guaranteed future of prosperity. Analysts wrote glowing reports, not based on sober stock analysis of their financials, but on the exciting stories of their products. Xerox was revolutionizing the office. Polaroid was putting a camera in every home. IBM was building the brain of the new economy. No one wanted to be the boring old fund manager talking about price-to-earnings ratios when you could talk about the future of technology. But beneath the surface of this euphoric consensus, a dangerous rot was setting in. The prices were becoming utterly detached from any semblance of business reality. Companies with modest growth prospects were trading at valuations that would have required them to grow to the size of the entire global economy to be justified. It was a bubble, but one that felt safe because it was happening in high-quality companies. This wasn't like the speculative penny stocks. This was the bluest of the blue chips. And then came the bear market of 1973-74, the same one that created the opportunity in the Washington Post. The economy soured, inflation spiked, and the spell was broken. Suddenly, investors started to care about earnings and valuation again. And they realized that the emperor had no clothes. The Nifty 50 stocks collapsed. It wasn't a gentle decline. It was a catastrophic implosion. Xerox fell from a high of $170 to $29. Polaroid, the darling of the era, crashed from $149 down to just $14, a decline of more than 90%. Avon products fell by 86%. These weren't small, speculative companies. These were the giants of American industry, and they wiped out a generation of investors who had bought into the institutional hype. The one-decision stocks turned out to be one-decision tickets to financial ruin. The Nifty 50 became a graveyard for capital, a stark and brutal lesson in the dangers of following the herd, no matter how intelligent that herd may seem. The institutional imperative had led the brightest minds in finance off the exact same cliff, all holding hands and smiling. The psychological principles at play here are deeper and more insidious than simple social proof. The Nifty 50 mania was a perfect storm of groupthink and pluralistic ignorance. Groupthink is a phenomenon that occurs within a group of people in which the desire for harmony or conformity results in an irrational or dysfunctional decision-making outcome. Dissenting opinions are discouraged, and the group isolates itself from outside influences. On Wall Street in the early 70s, the group was the entire community of institutional investors. The desire for conformity was driven by career preservation. The group collectively rationalized their decisions. These companies can't be overvalued because their growth is perpetual, and developed an illusion of invulnerability. Any analyst who dared to publish a sell rating on a Nifty 50 stock was seen as a heretic, someone who just didn't get it. This creates a powerful pressure to conform your own beliefs to that of the group. Even more fascinating is the role of pluralistic ignorance. This is a situation where a majority of group members privately reject a norm but incorrectly assume that most others accept it, and therefore go along with it. It's highly likely that many individual fund managers in 1972 looked at Polaroid trading at 90 times earnings and privately thought, "This is insane." But then they would look around and see every other institution buying it. They would assume, "I must be the only one who thinks this is crazy. Everyone else must see something I don't." And so they would suppress their own correct judgment and buy the stock anyway, not wanting to appear foolish or be the lone dissenter. This is the ultimate trap of the institutional imperative. It can turn a roomful of intelligent individuals, each with private doubts, into a mob that makes a collectively moronic decision. Each person is conforming to a belief that they believe everyone else holds, when in reality, very few might actually hold it with conviction. They are conforming to a phantom consensus. Breaking this spell requires a deep-seated intellectual independence, a commitment to your own analysis above all else. To cultivate this independence, you need a mental model that acts as a fortress against the pressures of groupthink. That model is the circle of competence. Popularized by Buffett and his partner Charlie Munger, the concept is deceptively simple, but its disciplined application is one of the most powerful tools for any investor or entrepreneur. Step 1 is to take out a piece of paper and honestly define what you know and what you don't know. What industries do you understand with genuine, deep familiarity? Maybe you've worked in software for 20 years. That's in your circle. Maybe you're a doctor and you understand the healthcare business. That's in your circle. Maybe you're a passionate consumer of retail brands and you understand their competitive dynamics. That's in your circle. Be brutally honest. Understanding how to use an iPhone does not mean you understand Apple's semiconductor supply chain or the economics of its app store. The goal is not to have the biggest circle, but to know precisely where the perimeter is. Step 2 is to commit to only making investment and major business decisions within that circle. This is the hard part. The world will constantly tempt you with exciting stories and hot trends from outside your circle. In the early 70s, it was electronics companies. In the late 90s, it was internet companies. Recently, it has been cryptocurrencies or AI stocks. The institutional herd will stampede toward these new, exciting areas where nobody has a real, time-tested competence. Step 3 is the critical discipline. When an opportunity arises outside your circle, you must learn to say pass. It doesn't matter if your neighbor is getting rich on it. It doesn't matter if it's all over the news. You say, "That's too hard for me. I don't understand it." This isn't an admission of stupidity. It's the highest form of intellectual honesty. It's the filter that protects your capital from your own ignorance and from the infectious euphoria of the crowd. The Nifty 50 managers thought they could understand dozens of complex businesses in rapidly changing industries. They expanded their circle to include everything that was popular, and in doing so, they erased the perimeter entirely. They became generalists in a game that rewards specialist knowledge. By defining and staying within your circle of competence, you ensure that your decisions are always based on a solid foundation of genuine understanding, not on the borrowed conviction of the herd. Now, let's contrast this disciplined approach with the path of the 99%. The average investor, and indeed the average fund manager, operates under the illusion that they need to have an opinion on everything. They feel pressure to participate in every new trend. Their portfolio becomes a mishmash of story stocks, hot tips, and whatever sector is currently in vogue. They are a leaf in the wind of market narrative. A key reason for this is the incentive structure of the professional wealth management industry. A fund manager is not primarily paid to generate the best absolute returns. They are paid to not lose clients. And the easiest way to lose clients is to dramatically underperform the market or their peers in the short term. This creates a perverse incentive to hug the index. They construct portfolios that look very similar to the S&P 500 or to their competitors' portfolios. This way, they are guaranteed not to be spectacular winners, but they are also guaranteed not to be spectacular losers. They are guaranteed to be mediocre. This is the institutional imperative in its most refined form. The explicit goal is to be part of the herd. Their path is not one of seeking alpha or superior returns, but one of avoiding career risk. They buy the Nifty 50 not because they have a deep conviction in their valuation, but because not buying them is a fireable offense if those stocks continue to go up. The tragedy for the retail investor who entrusts their money to these institutions is that they are paying high fees for mandated mediocrity. They are paying for a manager to protect his own job, not to grow their capital. The path of the 99% is a path of willful ignorance, of chasing trends outside one's competence, and of paying a premium for the privilege of running with the herd, often just as it approaches the cliff's edge. The financial connection of this behavior is devastatingly clear. Let's look at the numbers behind the Nifty 50 collapse. When you pay 90 times earnings for a stock like Polaroid, you are making a specific mathematical bet. A price-to-earnings PE ratio of 90 is the inverse of an earnings yield. It implies an earnings yield of just 1.1%, 1 divided by 90. The investor in 1972 was effectively trading their cash for an asset that was yielding them just over 1% per year in underlying business profits. At the time, you could get a U.S. government bond, a risk-free asset yielding over 6%. The institutional herd was making a decision that was, on its face, financially insane. They were choosing a risky asset with a 1.1% yield over a risk-free asset with a 6% yield. Why? Because they were hypnotized by a story of infinite growth. The direct financial consequence when that growth story faltered was a violent repricing of reality. As growth slowed, investors realized they had paid for a decade's worth of perfect growth in advance. The PE ratios had to come back to earth. This process, known as multiple compression, is what annihilated investors. The stock price is a function of two things: earnings and the multiple, the PE ratio, that the market is willing to pay for those earnings. In the Nifty 50 crash, earnings for many companies didn't even fall that much, but the multiple collapsed, from 90 down to 15 or 10. That alone is enough to cause an 80 to 90% drop in the stock price. It directly vaporizes the equity value on a company's and an investor's balance sheet. By ignoring valuation, the institutional imperative locks investors into a position of maximum risk. It forces them to buy assets where all the good news is already priced in, and any disappointment, however small, will lead to catastrophic capital gains losses. Adhering to a circle of competence and demanding a sensible price provides the ultimate defense. It ensures your portfolio growth is built on the solid rock of business value, not the shifting sands of market sentiment. The institutional imperative, as we've seen, can lead to both panicked selling of good assets and euphoric buying of overpriced ones. But to truly build a robust contrarian trading strategy, you need more than just a defensive mindset. You need a proactive method for finding opportunities that the herd is missing. You need a blueprint for independent thinking. This requires a willingness to do the hard, grubby work of investigation, to become a financial detective. And there is no better story to illustrate this than Warren Buffett's investment in American Express during the Salad Oil scandal. In 1963, American Express was a respected blue-chip company. Its primary businesses were its traveler's checks and its credit card, both of which were immensely profitable and trusted by millions. However, it had a smaller, obscure division involved in warehousing. Essentially, companies could store their inventory in an American Express warehouse, and Amex would issue a receipt for that inventory, which the company could then use as collateral to get loans from a bank. It was a sleepy, unglamorous business. One of Amex's biggest warehousing clients was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis. Allied had borrowed hundreds of millions of dollars from banks, all secured by warehouse receipts, for what was supposed to be a massive hoard of salad oil. Then, the scandal broke. It was discovered that Tino DeAngelis was a fraud. The warehouses were mostly empty. The tanks were filled with seawater, with only a few feet of salad oil floating on top to fool inspectors. It was one of the biggest financial frauds in modern history. When the news hit, Wall Street panicked. The banks who had lent money against the fake salad oil were facing huge losses. They turned to American Express, claiming that Amex, by issuing the warehouse receipts, was liable for the fraud. The potential liabilities were enormous, well over $100 million, a sum that many believed could bankrupt the company. The institutional imperative kicked in with brutal force. American Express stock was dumped indiscriminately. Who wanted to own a company facing potentially catastrophic legal liabilities from a massive fraud? The stock price was cut in half, falling from over $60 to just $35. The consensus was clear: sell now, ask questions later. The narrative was one of doom. The fear was palpable. But in Omaha, Warren Buffett saw the panic and felt not fear, but curiosity. He wasn't listening to the noise, he was asking a question. How much damage has this scandal actually done to the company's real, underlying businesses? Instead of relying on the opinions of other analysts, Buffett decided to do his own primary research, what the legendary investor Philip Fisher called scuttlebutt. He wasn't going to look at charts, he was going to look at reality. He started by visiting his local Omaha restaurants and merchants. He would go in and talk to the owners. He'd ask them about the American Express card. Did the scandal change their opinion of it? He saw that customers were still using the card just as much as before. The fraud in an obscure warehousing division had zero impact on the psychology of the average cardholder. Then he went to the banks. He would talk to the bankers, asking them if they were still selling American Express traveler's checks. They all said yes. The traveler's check was a product built on a century of trust. A scandal involving salad oil in New Jersey wasn't going to shake that foundation. He even visited a few competing travel agencies to see if they were pushing their own traveler's checks more aggressively. He found that the American Express brand was still the gold standard. Through this detective work, the scuttlebutt, Buffett confirmed a crucial insight. The company's primary profit engines, the card and the traveler's checks, were completely unharmed by the scandal. Their competitive moat was intact. The problem was contained to one small, non-core division. He then did the financial analysis and concluded that even in a worst-case scenario where Amex had to pay all the claims, the company's powerful earnings from its core businesses could easily absorb the blow over a few years. The market was pricing the company for bankruptcy. Buffett's investigation told him it was just a temporary, albeit nasty, flesh wound. Convinced by his primary research, he made an audacious move. He invested 40% of his partnership's entire capital into American Express stock. It was the single largest investment he had ever made. He was betting the farm on his own independent analysis against the unanimous, fearful consensus of Wall Street. The result was spectacular. The company weathered the storm, the legal issues were eventually settled for a manageable sum, and the core businesses continued to grow. As the fear subsided, the market realized its mistake, and the stock price roared back. Within a few years, Buffett's investment had multiplied fivefold, supercharging his early returns and cementing his reputation as a master of contrarian investing. He didn't have a crystal ball. He had a better method of inquiry. The psychological principle that Buffett masterfully overcame in the salad oil scandal is a duo of powerful biases: the availability heuristic and confirmation bias. The availability heuristic is a mental shortcut that relies on immediate examples that come to a person's mind when evaluating a specific topic. In 1963, the only thing that came to mind when investors thought of American Express was scandal, fraud, and bankruptcy. The dramatic, sensational news was readily available in their minds, and it overshadowed the more mundane but far more important reality of the company's profitable credit card business. The news of the scandal was vivid and emotional, causing investors to overestimate its long-term impact on the business. This is a classic trap for those who make decisions based on headlines. Then, confirmation bias kicks in. This is the tendency to search for, interpret, favor, and recall information in a way that confirms or supports one's pre-existing beliefs. Once an investor decided, based on the availability of the scandal news, that, quote, MX is in trouble, they would then actively seek out information that confirmed this view. They would read the most pessimistic analyst reports, focus on the size of the potential liabilities, and ignore any evidence of the core business's resilience. Buffett did the exact opposite. His scuttlebutt method was a deliberate, systematic effort to fight confirmation bias. He wasn't seeking to confirm the market's fear. He was actively seeking disconfirming evidence. He was testing the negative hypothesis. By talking to merchants and bankers, he was asking, is the negative story true in the real world? When the real world told him no, he had the confidence to act. The applied mental model here is the scuttlebutt investigation method. This is the blueprint for how a retail investor or an entrepreneur can practice true due diligence and develop an information edge over the market. It's about getting out from behind the computer screen and touching the real world. Step 1. After identifying a potential investment, is to brainstorm a list of all the key stakeholders in that company's ecosystem. Who are they? They are the customers, the suppliers, the employees, current and former, the competitors, and the local community managers. Step 2 is to systematically seek out conversations with these people. If you're looking at a retail company, go to its stores. Observe. How are the staff? Are the shelves stocked? Is it busy? Talk to the customers. Why do they shop there? What do they like or dislike? If you're analyzing a software company, try to find users of their product. What are their pain points? How does it compare to the competition? Scour online forums and reviews. Try to get in touch with former employees on a platform like LinkedIn. Ask them about the company culture and management. Step 3 is to synthesize this qualitative data. You are looking for patterns. Are the customers fiercely loyal? Do suppliers complain about the company being a difficult partner? Do former employees speak of a toxic work environment? This on-the-ground intelligence provides a texture and a reality that you will never find in a financial statement. It helps you understand the strength of the company's moat in a way that numbers alone cannot. Step 4 is to use this qualitative understanding to inform your financial analysis. If your scuttlebutt reveals that customers are abandoning a brand, it gives you a reason to be skeptical of rosy Wall Street growth projections. If it reveals a fanatically loyal customer base, it gives you the confidence to believe in the durability of the company's earnings power, even if it hits a temporary rough patch, as American Express did. This method transforms you from a passive consumer of information into an active investigator of business reality. The antithesis to this diligent investigative approach is the path of the 99%, which is characterized by passive, second-hand decision-making. The modern retail investor, and increasingly the institutional one, lives in a world of abstraction. They don't analyze businesses, they analyze data streams. Their inputs are not conversations with customers, but scrolling news feeds, social media sentiment analysis, and complex chart patterns. They are practicing what might be called screen-based investing. They are several layers removed from the actual business they are buying a piece of. A stock is not a share in a real-world enterprise. It is a symbol on a screen, a ticker, a line that goes up or down. This abstraction makes them incredibly vulnerable to the institutional imperative. When a scandal like the salad oil fraud breaks, the screen-based investor sees only two things: a plunging stock price and a fire hose of negative headlines. Their decision to sell is almost instantaneous, a reflexive reaction to negative stimuli. They have no deep, primary source knowledge of the business to anchor them. They haven't done the scuttlebutt. They haven't built their own conviction. Their conviction was borrowed from the market's prior positive sentiment, and when that sentiment reverses, their conviction evaporates with it. They are perpetually reacting, never anticipating. The disastrous consequence is that they are always one step behind. They sell after the bad news is already out, and the stock has already crashed, locking in their losses. And they will only buy back in long after the recovery is underway and the good news is obvious to everyone, ensuring they miss the majority of the gains. It is a perfect recipe for a lifetime of mediocre returns and a constant state of financial anxiety. The direct financial connection of Buffett's scuttlebutt method is profound. When American Express stock fell by 50%, the market was essentially saying there was a 50% chance the company was going to zero. The market capitalization was slashed in half because of a problem in one division. Buffett's investigation allowed him to see what the balance sheet didn't explicitly show: the enormous, intangible asset of the brand's trust and the loyalty of its customers. This intangible asset was the source of the company's real earning power, and it was undamaged. By investing 40% of his partnership's capital, a sum of around $13 million, he was making a bet with incredibly favorable odds. He correctly assessed that the probability of permanent capital loss was very low, while the potential for capital gains was enormous. The stock price quickly recovered and went on to be a multi-bagger for him. This single decision, born from contrarian thinking and detective work, dramatically accelerated his journey towards financial freedom. It demonstrates how a qualitative insight, gleaned from scuttlebutt, can lead to a quantifiable, massive financial advantage. While the rest of the market was selling based on the highly available and scary headline, Buffett was buying based on the less obvious but far more important reality of the business's enduring competitive strength. He was able to do this because the institutional imperative creates a market that overreacts to dramatic, salient news and systematically undervalues quiet, durable quality. For the investor willing to do the work, this market inefficiency is a goldmine. The institutional imperative does not just manifest in market manias or panics. It also operates at the very highest levels of corporate America, within the C-suite itself, driving CEOs and boards of directors to make disastrous decisions that destroy immense shareholder value. This is the imperative at its source, the engine room of corporate conformity. To understand this, we must examine what is perhaps the most infamous business deal of all time. A cautionary tale so potent that it has become a case study in every business school on the planet: the merger of AOL and Time Warner. In the year 2000, the dot-com bubble was at its absolute zenith. The market was in a state of mass delusion. Any company with a .com in its name was being awarded a valuation of billions of dollars, often with no revenue or viable business plan. The narrative was that the old economy of tangible assets and real profits was dead, and the new economy of internet eyeballs and limitless growth was the future. The institutional imperative was running at full throttle. No CEO wanted to be seen as a dinosaur. Every company was scrambling to acquire an internet strategy, to prove to Wall Street that they got it. In this feverish environment, two men, Steve Case of AOL and Gerald Levin of Time Warner, came together to architect the deal of the century. AOL was the king of the new economy. It was the leading internet service provider, the gateway to the online world for millions of Americans. Its stock had soared to astronomical heights, giving it an immense market capitalization built almost entirely on hype and expectations of future growth. Time Warner, on the other hand, was a titan of the old economy. It was a media conglomerate that owned a treasure trove of real assets: Warner Brothers Movie Studios, HBO, CNN, Time Magazine, and a vast cable television network. It was a hugely profitable, powerful company, but in the eyes of the market in 2000, it was boring and slow-growing. Gerald Levin, the CEO of Time Warner, was under immense pressure. He was terrified of being left behind by the digital revolution. He saw what the market was doing, rewarding dot-com companies and punishing old media stocks. Driven by this fear, he made a catastrophic decision. He agreed to merge Time Warner with AOL, allowing the new economy upstart to acquire his venerable old economy giant. The deal, valued at a staggering $164 billion, was the largest merger in corporate history. On paper, AOL, with its inflated stock, was the senior partner. The press hailed it as a visionary fusion of content and distribution, a company that would dominate the future of media. The herd roared its approval. The stock of both companies initially jumped. The CEO mindset was one of invincibility. But the vision was a mirage. The merger was a textbook example of the institutional imperative driving executive decision-making. Levin wasn't buying AOL based on a sober analysis of its business. He was buying a story, he was buying relevance, he was trying to appease a market that had gone insane. The reality was that AOL's business model was already crumbling. Its dial-up internet service was rapidly being made obsolete by the spread of broadband. Its value was based on a temporary technological gateway that was about to disappear. The new economy, darling, was in fact a melting ice cube. The old economy stalwart, Time Warner, was the real source of value, with its timeless content and cash-gushing cable systems. The merger closed, and almost immediately the dot-com bubble burst. The market woke from its delirium. Internet stock valuations evaporated overnight. The newly formed AOL Time Warner saw its stock price collapse. The promised synergies never materialized. Instead, the two companies were plagued by a massive culture clash between the aggressive, sales-driven culture of AOL and the more traditional, creative culture of Time Warner. The fallout was apocalyptic. Just 2 years after the merger, the company was forced to take a goodwill impairment charge of nearly $100 billion, at the time the largest such write-down in history. It was a stunning admission that the value they had paid for AOL was a phantom. Billions upon billions of dollars of shareholder wealth were vaporized. Gerald Levin lost his job. Steve Case was pushed aside. The deal is now universally regarded as the worst merger of all time, a monument to the destructive power of herd-like thinking at the highest echelons of business. The psychological drivers behind this disaster are a potent cocktail of the overconfidence bias and the sunk cost fallacy. The CEOs at the helm of these companies, particularly in the heady atmosphere of a bull market, are incredibly susceptible to overconfidence. They are celebrated as visionaries, their pictures are on the covers of magazines, and they start to believe their own hype. They believe they can do no wrong. This overconfidence leads them to undertake huge, risky bets, like the AOL-Time Warner merger, often with little margin for error. They overestimate their ability to predict the future and manage the complexities of integrating two massive, disparate organizations. The institutional imperative feeds this bias. When all your peer CEOs are doing big deals and being celebrated for it, the pressure to do your own transformative deal becomes immense. It's a game of corporate ego. Then, after the deal is done and it starts to go wrong, the sunk cost fallacy takes hold. This is our tendency to continue with an endeavor if we have already invested time, money, or effort in it, whether or not the current costs outweigh the benefits. For years after the merger, the leadership at AOL-Time Warner refused to admit the monumental scale of their mistake. They had invested so much capital, so much reputation, so much ego into the deal that they couldn't bring themselves to unwind it or change course. They kept throwing good money after bad, trying to make the flawed strategy work, long after it was clear to the outside world that it was a failure. This psychological trap prevents executives from cutting their losses, leading to even greater destruction of value. To avoid this path to ruin, both for entrepreneurs and investors evaluating a company's leadership, we need a mental model that acts as a powerful antidote to hype-driven decision-making. That model is the inversion technique, championed by Charlie Munger. Instead of asking, how can we make this project or investment succeed, you start by asking the opposite, how could this completely and utterly fail? The process is simple but profound. Step 1. Clearly define the goal. For AOL and Time Warner, the goal was to create a dominant, vertically integrated media company for the digital age. Step 2 is to brainstorm, with brutal honesty, all the possible ways this goal could fail to be achieved. Don't think about success, only think about failure. For the merger, the list would have been long. What if the dot-com bubble bursts and AOL's valuation evaporates? What if broadband internet makes AOL's core business obsolete? What if the corporate cultures are completely incompatible and create internal warfare? What if the promised synergies are just a fantasy, and we can't actually sell Time Warner content to AOL subscribers? What if we are massively overpaying for a technologically inferior asset? Step 3 is to analyze this list of potential failure points and identify the most catastrophic ones. In this case, the obsolescence of dial-up and the bursting of the valuation bubble were the killer risks. Step 4 is to design your strategy explicitly to avoid these critical failure points. By starting with the potential for failure, the inversion technique forces you to see the risks that are often obscured by optimistic projections and herd-like enthusiasm. An intellectually honest inversion process would have likely led the Time Warner board to conclude that the risk of permanent capital impairment in the AOL deal was unacceptably high. For a retail investor, this technique is a powerful tool for stock analysis. Before buying any stock, especially a popular high-flying one, spend an hour inverting. Ask, how could my investment in this company go to zero? This exercise will force you to confront the real risks and will save you from being swept up in the next market mania. The path of the 99%, the path taken by Levin and so many other CEOs, is the exact opposite of inversion. It is the path of pure, forward-thinking optimism, untempered by a healthy dose of pessimism. They start with a grand, exciting vision. They fall in love with the story. The narrative of the digital revolution and synergy was so compelling that it blinded them to the glaring risks. This is common behavior for the average retail investor as well. During the dot-com bubble, millions of people poured their life savings into companies with no profits and no business model, all because they fell in love with the story of the internet. They didn't ask, how could this company fail? They only imagined how it could succeed, dreaming of 10x returns. They were not investing. They were buying lottery tickets with fancy narratives attached. The 99% path is also defined by a focus on optics. Gerald Levin was more concerned with how the merger would be perceived by Wall Street as bold and visionary than with the underlying economic realities of the deal. The institutional imperative pressures CEOs to make decisions that look good in the short term, that generate positive headlines, even if they are destructive in the long term. This focus on perception over reality is a recurring theme in the graveyards of failed businesses and wiped-out investment portfolios. The direct financial connection of this executive-level herd behavior is written in the language of the income statement and the balance sheet. When AOL acquired Time Warner, the massive premium it paid for Time Warner's assets was recorded on its balance sheet as goodwill. Goodwill is an intangible asset that represents the excess of the purchase price over the fair value of the identifiable net assets acquired. When the dot-com bubble burst and it became clear that the future earnings power of the combined company would be nowhere near what was projected, accounting rules required them to impair or write down the value of that goodwill. The nearly $100 billion write-down was a non-cash charge, but it was a direct, public admission that the asset on their balance sheet was a lie. That $100 billion was a direct subtraction from the company's book value and shareholder equity. It was the financial smoke clearing to reveal a crater where shareholder capital used to be. For investors, understanding this connection is critical. When you see a company making a large, splashy acquisition of a trendy company at a high valuation, especially using its own inflated stock as currency, it should be a massive red flag. It is often a sign that the institutional imperative is at work, that the CEO is chasing a narrative rather than creating real value. This behavior, which Buffett calls diversification, is one of the most efficient ways for management to destroy the capital that you, the shareholder, have entrusted to them. Avoiding companies led by CEOs who follow the herd is just as important as avoiding the stocks the herd is chasing. We have explored the institutional imperative as it manifests in market panics, manias, and corporate boardrooms. The final piece of the puzzle is to understand how a true contrarian, a master of this principle, connects all this psychological insight directly to the cold hard numbers on a financial statement. It's about learning to see the story the numbers are telling, a story that is often the complete opposite of the narrative the market is shouting. It's about developing a kind of financial X-ray vision. And the perfect story to illustrate this is not one of a dramatic crash or a scandalous fraud, but a quiet, simple, and profoundly brilliant acquisition. Buffett's purchase of See's Candies in 1972. At the time, Berkshire Hathaway was still primarily a struggling textile business. Buffett and Munger were looking to deploy its capital into better businesses. Through an investment banker, they were introduced to the See family, who were looking to sell their California-based candy company. See's Candies was the opposite of a hot, trendy investment. It was a boring, old economy business. It made chocolates and sold them through its own retail stores. There was no exciting technology, no explosive growth story. To the institutional investors of the day, obsessed with the Nifty 50 and electronics companies, a business like See's was invisible. It was a relic. Buffett and Munger, however, saw something different. They flew out to California and dug into the business. What they found was a financial masterpiece. See's sold about 16 million pounds of candy a year at about $2 a pound. The company had annual revenues of around $30 million and pre-tax profits of about $4 million. More importantly, the business required almost no capital to operate. It had very little inventory, as the candy was sold fresh, and customers paid in cash, so there were no receivables. The factories and stores were old and had been fully depreciated. It was a cash generation machine. But the real magic of See's Candies wasn't just on the balance sheet. It was in the minds of its customers. Buffett discovered that the brand had immense, untapped pricing power. People in California had an emotional connection to the See's brand. They bought it for Christmas, for Valentine's Day, for birthdays. Giving a box of See's was a tradition. When a boy took a girl on a first date, he would bring a box of See's to her mother. This deep well of customer goodwill meant that the company could raise its prices a little bit each year to account for inflation, and customers wouldn't blink. They weren't just buying candy. They were buying a feeling, a memory, a trusted brand. This pricing power was an incredible economic moat that didn't show up on any financial statement. The See family was asking for $30 million for the business. Buffett's initial analysis showed that the tangible assets, the factories, the stores, were only worth about $8 million. Munger was hesitant. Paying $30 million for a business with only $8 million in book value seemed too expensive. It violated the classic cigar-butt value investing principles they had followed up to that point. But Buffett had a crucial insight. He realized they weren't just buying the assets, they were buying the brand. They were buying the pricing power. They were buying the future stream of cash flow that this durable moat would generate. a stream that would grow over time with minimal need for additional capital investment. They offered $25 million, and the family accepted. It was a pivotal moment for Buffett. It taught him that it was better to pay a fair price for a wonderful business than a wonderful price for a fair business. The institutional imperative of the day was to either buy cheap, low-quality cigar butt stocks or to overpay for high-growth Nifty 50 stocks. Buying a high-quality, modest growth business at a reasonable price was a strategy no one else was following. The results were astounding. See's Candies, the boring chocolate company purchased for $25 million, has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital. It became the prototype for the kind of business Buffett would look for again and again. It was a contrarian investment not because it was in a hated industry, but because it was in a neglected one. The herd was chasing exciting stories. Buffett was buying quiet quality. The psychological principle that Buffett and Munger were leveraging here is the flip side of the coin we've been examining. They were exploiting the market's narrative fallacy and its corresponding neglect of base rates. The narrative fallacy is our tendency to prefer stories over statistics. The institutional herd in the early 70s was captivated by the exciting narratives of technology and global growth. Stories of Xerox's Office of the Future or Polaroid's instant photography were far more compelling than the story of a regional candy company. These exciting narratives caused them to overvalue the Nifty 50. At the same time, the boring narrative of See's Candies, "We make chocolate and people like it," caused the business to be completely overlooked and undervalued by the wider market. Compounding this was the neglect of base rates. A base rate is a statistical fact or the underlying probability of an outcome. The base rate for high-tech, high-growth companies is that most of them will fail or will not live up to their lofty expectations. The base rate for a dominant, established consumer brand with pricing power is that it will very likely continue to be profitable for a very long time. The institutional herd, swept up in the narrative of the new economy, ignored these base rates. They bet on the long shot with the exciting story and ignored the sure thing with the boring one. Buffett and Munger did the opposite. Their analysis of See's was a pure base rate decision. They recognized the high probability of continued success for a business with such a strong moat and customer loyalty. They chose the boring high probability bet over the exciting low probability one. The applied mental model for this is the look-through earnings analysis. It's a method for financially X-raying a business to see its true cash-generating power, cutting through the noise of GAAP accounting and market narratives. Step 1 is to start with reported net income from the income statement. This is your baseline, but it's often misleading. Step 2 is to adjust for accounting fictions. Add back large, non-cash expenses like depreciation and amortization. Be particularly wary of large goodwill write-downs or restructuring charges, which companies sometimes use to manipulate their earnings. Step 3 is to make a crucial deduction. Subtract the average annual amount of capital expenditures, CapEx, the business needs to maintain its operations and competitive position. This is the maintenance CapEx. This step is critical. A company might report high net income, but if it has to spend all that income on new factories and equipment just to stand still, it's not actually generating any free cash for its owners. A business like See's Candies is the holy grail because its maintenance CapEx is extremely low. Step 4, the resulting number is your owner earnings or look-through earnings. This is the real, durable cash profit of the business. Step 5 is to compare this owner earnings figure to the market capitalization of the company or the purchase price in an acquisition. This gives you a true earnings yield. A high owner earnings yield on a business with a durable competitive moat is the hallmark of a great long-term investment. This method forces you to focus on the cash, the lifeblood of any business. It immunizes you from being fooled by exciting stories about companies that are burning through cash in the name of growth. The antithesis, the path of the 99%, is a relentless focus on top-line growth and narrative. The institutional imperative often drives CEOs and investors to prioritize revenue growth above all else, even if that growth is unprofitable. This is the growth at any cost mindset. A classic example is the corporate behavior Buffett calls empire building. Many CEOs are incentivized, both by their egos and their compensation structures, to make their company as large as possible. They will often pursue mergers and acquisitions, not because they make strategic or financial sense, but simply to increase the size of the company's revenue and assets. This frequently leads to diversification, acquiring unrelated businesses that they don't understand and that destroy shareholder value. They are chasing the narrative of being a large, important, growing company, but they are ignoring the base rate, which shows that most mergers and acquisitions fail to create value for the acquirer's shareholders. The retail investor who buys into these stories, who gets excited about a company's rapid revenue growth without looking at its owner earnings or its return on invested capital, is falling into the same trap. They are buying the story, not the business. They are mistaking activity for progress and size for value. The direct financial connection of the See's Candies acquisition is a masterclass in capital allocation. Berkshire paid $25 million for the business. Let's say in its first year, See's generated $4 million in pre-tax owner earnings. That's a 16% pre-tax return on their investment from day one. But the real magic was what happened next. Because the business required so little additional capital, that $4 million in profit was free to be sent back to Berkshire's headquarters in Omaha. Buffett could then take that cash and reinvest it in other undervalued assets. The next year, See's would raise its prices a bit, earn perhaps $4.5 million, and send that cash back to Omaha. See's Candies became a financial engine, a perpetual cash cow that funded Berkshire's growth for decades. This is the ultimate financial advantage of buying high-quality, low-capital intensity businesses that the herd ignores. They produce a constant, growing stream of cash that can be redeployed elsewhere, creating a powerful compounding effect on your portfolio growth. The institutional imperative, with its focus on either glamorous growth stocks or statistically cheap junk, systematically misses these quiet compounders. By learning to look through the numbers and identify the underlying economic engine of a business, you can find your own See's Candies, the boring, overlooked, cash-gushing machines that are the true secret to building lasting wealth and achieving financial freedom. You have just spent this time absorbing a powerful mental framework. You have been given the lens to see the ghost in the machine, to identify the institutional imperative as it plays out across the entire financial landscape. You now understand the psychological forces of social proof, groupthink, and narrative fallacy that drive the herd. You have the blueprints, the owner-focused valuation, the circle of competence, the scuttlebutt investigation, the inversion technique, and the look-through earnings analysis, to build a fortress of independent thought around your capital. You now possess the tools to see the market's biggest blind spot, the recurring, predictable pattern of mistakes made by the so-called smart money. This is a profound advantage. But identifying the flaw is only the first step. Knowing why the herd is wrong is one thing. Knowing precisely what to do with that knowledge is another. What do you do once you've stepped away from the crowd? How do you accurately value the lonely, neglected assets you find in the market's forgotten corners? Buffett's strategy is not a collection of disconnected tricks. It is a complete, interlocking system of thought. You have just mastered a single, crucial pillar of that system: how to think differently. The next, equally critical pillar is how to calculate precisely. The video that is now appearing on your screen is not a random suggestion. It is the next piece of that system. It is the bridge from spotting the institutional mistake to mathematically capitalizing on it. It's the essential link that connects the qualitative art of contrarian thinking to the quantitative science of valuation. Others will click away now, content with knowing the theory. They will feel smarter, but their actions tomorrow will be the same. But for those of you who are not here for entertainment, but for transformation, for those who are serious about building a portfolio that can weather any storm and achieve real, lasting financial freedom, The choice is clear. The journey does not end here, it is just beginning. Continue your ascent. Complete your mental arsenal. The next critical lesson is waiting for you.